that music and all those legal words means we are ready for another episode of the Halftime Report, a Thursday, a Theta Thursday. Listen, Theta working in the market today. Well, I should say anti-Theta. Short-term traders buying puts or calls at the end of the day yesterday, being like, S&P basically unchanged after a bloody day yesterday, nasty, some wicked price action, especially in certain areas of the market, doing its best to bounce off support, but we'll break all of that down. Do our best to make a little bit of sense out of the chaos. Matt,
Yes.
Thursday, how are you doing?
I am doing fantastic. I'm excited to be here with the team again to break down the market activity. And I can't wait for that moment where I'm like, yeah, let's buy that breakout. Do you see this rip roaring market? I think we're all a little bit fatigued analyzing the volatility and the wicked nature of price action these days. But we're going to start off this Thursday on a little bit of a positive note with the marketplace. And I've said this a few times. Double wick bottoms can be an indicator of market price action because of potential reversal price action, given the fact that double wick bottoms are typically put in by algorithms. And that's kind of the beginning nature of a support type of build. And you've had a couple double wick bottoms, one over here, a little bit of a double wick bottom, saw that rally there, had another double wick bottom here and again, keep an eye on this candle here, Chucky, because it does remind me a tremendous amount of this candle here. As you can see, you got that initial surge down here, market recovers coming into that resistance level. Here's Amazon day, by the way. That's Amazon day. Comes down, nails that wick right there. Market tries to rally, can't sustain the bid, comes right back down. And so you do have a double wick scenario where I will say it does shift the probability a little bit to where we see some stabilization here, but you don't have to go back into the future very long to understand that volatility is the kryptonite to all things technical analysis. And we just had a double wick bottom here that got violated. And so you do have a double wick bottom, which can be an indication of slowing momentum. It can be an indication that the algorithms are start to really kind of build off that support level that was ticked at around that 38.50 level just a few days ago. And so it's an interesting slowing momentum moment on a Thursday. But that's all I'm taking it as of right now, is just a little bit of slowing momentum in the face of a lot of market volatility and a lot of negative sentiment out there. Probably even more negative sentiment than negative price action right now.
Oh my goodness, Matt! Like everyone, if I have to read one more bear, how the S&P is going to 20. They're getting so outlandish now that it's like, all right, we're going to go back and test the COVID lows.
When the economy was legitimately completely shut down.
It is just the emotions run high.
I wonder what they would realize when they figure out the GDP of America is actually expanding still. Like, I wonder what they're going to say.
No, it's not, man. I read 4,000 headlines yesterday that said that a recession is guaranteed, right?
Listen,
we're already in one, apparently.
No, it is not. No, it is not. It is not guaranteed. We are not there yet economically. And can it happen? Absolutely. Has the probability enhanced? 100%, or the Fed wouldn't be raising rates. And so all of those are kind of baked into the price. But the reality is this happens every single time. Every single time any market goes down 20%, that is traditionally what is considered a bear market. And so whenever you get the S&P 500 going down 20% and it triggers that traditional bear market analysis, you will get everybody and their dog trying to front run calling the market top. Well, the market already topped 5 months ago, and we've already been in a bearish market for quite a bit of time here based on a technical perspective. And if you take a look at the readings of the entire marketplace and not just the basket of stocks called the S&P 500, this market's been in a tremendous bearish downtrend for a very long time. And so it happens a lot, and it certainly can get frustrating and it can get overwhelming at times, given the fact that now, once the market does trigger stuff like that, you see everybody trying to front run the headline. And that's what it is. Everybody's trying to front run the headline. I just want, and that's why I really just try to focus on technical analysis here, because it is not what somebody says. And I've always said this to all new traders. It is the power of technical analysis it's the truth of the market. When you deal with the market, you deal with a lot of misdirections. When you deal with the market, you deal with a lot of opinion that could be not market relevant, to be quite frank. And so you got to be able to cut through that noise a little bit. And the truth of the market is not what somebody says. The truth of the market is what the collective market does from a price action perspective, meaning buying and selling. And so it's technical analysis that really does allow us to navigate not only the choppy waters of volatility of price action, but the choppy waters of volatility and opinions out there in CNBC versus Market Watch versus what the banks are trying to do. Everybody's trying to front run the negative headlines. And so it can be extremely overwhelming. Technical analysis is the truth. And what the example I've typically given in history is when you were think about Enron, for example, all the way back, Enron. Chucky, Enron, about 6 months before they went belly up and bankrupt, and that horrific story of what Enron did in ripping off all of their, pension and everything like that to the tune of billions and billions and billions of dollars. Before Enron went belly up, they had an earnings report where they came out and reported record profit, record revenue, record everything, painted the most rosy picture of all time. And yet, what was the price doing? Price was going down, 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 down. Well, why was the price going down despite Enron reporting record revenue, record profit, record guidance? I mean, that's not what happens. That's not how it works. If you have a company out there coming out and saying, we beat EPS, we beat revenue, and we're increasing guidance, that's called a hat trick at tackle trading. That usually goes up in price, but Enron's going down, 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 down. Why? Because the insiders were dumping the shares of the stock. And so what was the truth of the market? What they were saying or what they were doing? See, what they are doing is always reflected in the price action. I'll give you another quick example. Jamie Dimon, a few years ago, a reporter asked him, Jamie, what do you think of Bitcoin? This is like back in 2018. Jamie Dimon says, and he's the head of JP Morgan Chase, and he says, if I catch one of my traders trading Bitcoin, I'm going to fire him. Well, it came out the next day that Jamie Dimon, and Bitcoin goes down like 20% in that day. Came out the next day, Jamie Dimon was actually buying Bitcoin. So what was the truth of the market? Because Bitcoin recovered. What was the truth of the market? Was it what Jamie Dimon said, or was it what Jamie Dimon did? It was what Jamie Dimon did. See, price action is the truth of the market. You can't shield it. You can't hide it. You can't make it something that it is not. A big red candle is a big red candle. A big green candle is a big green candle. A bullish uptrend is a bullish uptrend. A bearish downtrend is a bearish downtrend. Support is support. Resistance is resistance. You can't shield those things. You can't hide those things. And so technical analysis, and that's why I constantly come back to, in these times, the number one form of analysis is technical. We have an understanding of what the economy is doing from an economic perspective. We have an understanding of where the consumers are from a behavioral perspective. But where you're going to find this market bottom is not by people out there in la la land screaming bloody murder. And no, we know there's blood in the streets. We know the damage that the market has been going through. We've been living this market for the last 6 months. We don't need some guy or gal on CNBC screaming, waving their hands and screaming bloody murder and the end of the world is occurring. That's not what we need. What we need is see a doji as support. We need to see a double wick bottom. We need to see a market break back up into resistance. We need to see some consolidation and some stabilization and price action. That's what we need. I don't need to hear anybody else. I need to see some slowing momentum in this chart. That's what I need.
No, I mean, and I am very, very much of the opinion, because I read all of the bearish arguments, right? I read the bullish arguments.
See, I don't even have to read the bear arguments because I got you.
And the basic bearish argument right now is very, very simple. that the Fed is going to raise interest rates and be aggressive enough and trigger a recession. That is what it is. That is the sum of it. And then, of course, everyone has their best doom and gloom what that means, right? Does it, Deutsche Bank said if that occurs, then an S&P 3000. Josh Harnett from Bank of America says 3,200. Mike Wilson says 34. Everyone has their all right, this is going to happen. But then you have the bulls on the other side, let's say, slow your horses. Marco Kolanovic of JP Morgan out there saying, listen, we're not going into a recession, and so that is the debate, that is the fear, that is the worry. And and Jay Powell the other day did not alleviate any of those fears when he basically said we're going to raise interest rates until the cows come home. If we're going to fight inflation, Matt. Did you know that?
And honestly, if inflation persists, and they should absolutely be aggressive in combating against inflation, because if you don't try to drill inflation when it starts sparking, it's damn near impossible to turn off. It is. You start to see runaway inflation. I can give you, out of the 100 or so times we've seen the death of currency in the last 100 years, Chucky, you've had a lot more that had a risk of it. But once you spark runaway inflation, there is only two ways to get rid of runaway inflation, and both of them are completely horrific. And so you got to combat the most challenging environment of our time, and that is inflation. You got to fight that. But the reality is, simply because you raise interest rates and you go into a net neutral position, it doesn't mean you spark a repeat of the dot-com crisis. And that's my disagreement with what I'm hearing out there, is everybody screaming that we're going through dot-com. Well, I don't know. I don't know if we're going through dot-com yet. I do know that there is some hallmark examples of what is going on right now that is comparable to .com. I do know .com led the tech bubble led the .com. Tech's leading here as well. You got more consistent, sustainable price action to the downside here, circa 2008, circa 2015, circa 2000 through 2002 than you do in the pandemic. But I also know the market cycle fairly well, Chucky, and it lasted about 8 years. And in that 8 years, we typically see about 20% downward movements in price. One will spark that 40 to 50%, the other recovers. And so, yes, it is absolutely in the cards for further downward movement in price. But before the S&P, and by the way, anybody that says 3,000 in the S&P is just making up numbers.
Oh, they're just making up numbers, right?
Legitimately making up numbers. There's and I'll say this again, before we get to 3,000, you first got to break through a few other support levels first, right? And so if we do see the consistent downward movement in price, Mark, my base case is down to about 3,500. And so when you're looking at that downward movement in price, and this is the bear argument that I've been making, is the problem with the market is after you broke that 4,100 zone, there's no support levels here. There's no support between that 4,100 zone and when you work into that 3,500 zone. And so the problem that I see for the market here is, yeah, you do have a lot of negative chatter out there, and the put to call ratio is out of control right now, and the bearish, the thirst for bearish is strong out there right now. But one of the biggest problems I see in the market is this is a no man's land. This is a no man's land.
And that's what it is. That is what it is for me, Matt, because I hear Marco Kolanovic, and I think the bulls make a legitimate case, especially when you get in oversold conditions. I mean, it's been a long time since the market had, 7 straight down weeks. It's been a minute.
It wasn't even. It's got to be 08.
And that's one of the things that when I talk to my traders in Cash Flow Vikings, and when I'm in the Traders Lounge at Tackle Trading, this is what's made this one of the more challenging environments, because 2018 and COVID, they kind of were over before you knew it.
Historically, you blink and you missed it, like from a technical perspective.
Yeah, I mean, the pain was real in COVID for a few weeks, and in 2018 for like 7 days. But it was over before you knew it. right? And then you quickly, this has been this slow, steady grind downward.
Chucky, I
I
think
mean,
the pandemic is only like 4 weeks now.
yeah, I mean, if you go back, you're going to have to
4 weeks.
You're going to have to go back a long time.
It's got to be 08. I got to check now, but off the top of my head, I would say 08. The September, October, 08.
Because you didn't have it in 2015. You didn't have let's do a little time journey here.
I think I gotta say 08 here, Chucky.
Maybe at the end
but
of
I'm
08,
not
but
even
I'm not even sure
bro. I'm not even
that.
sure we got 7 in 08.
Like,
that's a downward. So you got 1, 2, 3, 4, 5, 6 here. Yeah, that's an upward. No.
I mean, and you can definitely tell the 2-week period where Lehman Brothers collapsed and everything happened.
This is this Bear Stearns is right here. This is Lehman Brothers right here. This is the announcements of the bailouts right there. This is the initial announcement of quantitative easing right there. This is
that was people just freaking out at the very
and this is basically the Fed coming out and saying, oh, we were kidding. We're gonna go even more on quantitative easing. And so I mean, if you want to do a historical journey on how QE has impacted the marketplace, I find it extremely educational, by the way, and it will teach you quite a bit about why the market's going down here. But again, you come back to the technical challenging environment here, and again, you've had a lot of negative themes. My disagreement with a lot of the recessionary chatter is simply because I feel a lot of these individuals are trying to get headlines and not putting out great analysis out there. But I will be the first to admit the probability has certainly increased for a recessionary environment. I'm more concerned, and this is a bigger concern for me than recessions, because recessions historically, we have them, we get over them, we move on. Historically, they're never fun. Nobody ever wants to go through them. It sucks for that entire year typically, but typically we recover and we move on. We've had 13 recessions since the Great Depression, Chucky. 13. When you ask people that like if you go out on the street and you just ask, hey, how many recessions have we had in the last 100 years? Typically people will say 2 or 3. We've had 13. They happen quite a bit. They happen every 7 to 8 years based on the market cycle. Not all the time do they spin out of control like the .com or the subprime or the Great Depression. A lot of times they come down, market stabilizes, market recovers, market moves on. Stagflation is nasty, because stagflation, you have a growth environment, things seemingly feel good economically, but the consumer can't afford anything because stagflation rips out any of the growth. So you make 3, 4, 5, 6, 7, 8% additional money every year, but the cost is going up so dramatically that you can't offset that. And then that sparks runaway inflation, because governments do a lot of stupid stuff in that environment. And so in that stagflationary conversation, that's a pretty big concern I have personally. But in terms of the recession, again, I do think the probability has increased, but I still think the base case, even in a recessionary environment, is 3,500. I wouldn't put it under 3,500, because that, again, you got a pocket here, and you got to realize the S&P is shielding a little bit of the damage that has already been done in the marketplace. Would you agree with that, by the way, Chucky?
Yes.
Even the 20% downward movement in price in the S&P has shielded some of the damage.
And I was talking to you about this because the damage has been extensive for 6 months.
Yeah.
What I think is going on now, because the underbelly is actually held up really well this week.
Chucky, I want to get your take on that. We'll come back to the S&P here in a second.
And one of the things that I'm interested.
ARK is crazy to me in the last 5 days.
The precision there. Listen, I had a little trade that if the ARK had taken off, I would have made some bucks, and the ARK decided to be like. This is
pure K trade here, Chuck. Pure K trade.
I had a trade that I could make money either way, and then the ARK decided to do this.
Can I take a moment, because Kevin, one of our pro members, asked a question in Discord earlier today, and I did answer the question, but the question was, hey, there's a couple patterns that you guys talk about that are not actual technical names. And because you know how we do it at TAG,
we make up our own language.
We'll make up our language every now and then. One is a K trade. And a K trade is basically, and I'll read the definition as I gave it in Discord earlier today. I said, okay, the K trade is a neutral trade with tight consolidation where the pattern will break into a new trend, and thus the trader is looking at a trade where they would short a break of support or buy a break of resistance. Can you find a better example of that than the ARC ARC right now?
The tightness of the range, and I
Look
have
at
a
that
theory.
tight range. It's amazing.
Listen, and I have a theory because I know everything, you know,
Ooh,
because
let's hear it.
I've been reading ARC go down to 7, you know, like single digits in the ARC, and everything underbelly is going to go to $2 and this and that. I'm like, the damage has been so extensive. I mean, any pricing in, you have companies priced for bankruptcy at this point, even though you have companies that have more cash than their market
You have
cap.
companies that have basically a book value that exceeds their market cap right now.
Yeah, I mean, you know, some of the, like, you know, valuation is a funny thing, right? In underbelly, you can't valuate it on PE ratios and this and that because a lot of them are unprofitable. But like price to sells, some of the price to sells of the underbelly stocks are at like just downright.
Well, you can't do the traditional easy metrics of PE ratios and PEG ratios and forward PE ratios, which are very, very simple to use. You have to look at some of those Coach Greg metrics, the price to book, price to sales, price to free cash flow. You have to use those types of metrics when you're looking at growth stocks.
No, and you know, and the damage has been so done. It's like I think there is a common sense, like, all right, this thing's already went through the .com. It's already went through the .com. Now, can price go lower? Sure, right? You know, but like, do you expect it all? You know, because I see people out there saying, well, you know, if it's gone down 90, it can go down another. You know, yeah, sure, right?
Yes, it can. Yes, it can. Yes, absolutely. But what does the valuations look like at that point?
What does the valuations? Is the company still growing? Do they have enough cash to weather storms? You know, like, there's so many things that go into the decision making that, you know, right now I think, you know, it's almost like it's a take turn. It's almost like reverse rotation potentially, Matt. If the S&P breaks support, right? You got to break support, because if you don't break support, in fact, if you don't break that double wick, you don't break support, you don't break support. And that's why technical, I'll get to that in a second, but it's almost like you have a reverse rotation, right? It's like you had six months of pain everywhere. And then it's like things taking a turn, you know, now. It's like, we'll send Staples down, we'll send Apple down. Well, like, you know.
Well, I guess for me, it's just like, yes, a stock that goes from $100 to $10, a 90% decrease in price, it certainly can go from $10 to $1. There's no doubt about that. But the argument starts to be made that with this tremendous drop in price that you've already had in the growth areas of the market, that there is a certain amount of pricing in factor that is already been going in.
And that's what it is. It's like when people were worried about the Fed turning hawkish and as inflation in 2021, it's like, let's price in the easy stuff. Let's kill the stuff that is obviously.
What did we say in December of last year? 2022 can't be the year where you look at stocks that have zero earnings. It cannot be. That was the message all of December, from when the Fed confirmed their pivot all the way through the end of January, when Goldman Sachs confirmed the radical shift in monetary policy. And so from that point on, that rising interest rate environment, I can't remember how many times we said it here on the halftime report or in the podcast. Listen, you got to make money in 2022. That was it. And you've seen in the last 5 months, you've seen that downward movement price so aggressive in these areas of the market that have a negative PE ratio, that have, you know, that are technically considered growth or part of the ARC, that you've already had that being priced in. And so I think and that's why you're starting to see those value arguments being made out there, is because you're starting to see valuation on these types of companies that otherwise you haven't had in the past. In the past, to participate in this area of the market, you had to pay for ultra growth. You had to pay massive premium to participate in the ultra growth side
for 10 years.
Not since pandemic.
For 10 years.
The pandemic reset that. It's been since 2010
Yeah,
It's
you've
been
had to
that
do it for
way.
10 years to get into the growth area. You've had to pay outlandish premiums. That is starting to not be the case anymore.
I agree.
And I have, this is my current working theory on the market, Matt. And I'm going to go over this with my cash flow Vikings tonight, but I'm going to share it here right now. Is that you have a controlled demolition. I saw some comments yesterday that yesterday was the most orderly panic day in the history of the market, where it was a huge day down, right? But it was this controlled demolition. And I think what's going to happen in the market is that, there's going to be a natural, all right, risk off, because guess what? A lot of us were early to the party in getting risk exposure down. Not everybody has been, right?
No.
Not everyone has. So I think a lot of funds, I think there's going to be a risk off. Let us reduce exposure. Let us get it to a manageable point. And, take some of the areas that are still a little high on the chart, maybe down a little bit. And I think what is going to happen is that when that de-risking is over, you're going to see it on the chart with technicals. You're going to see a support level come down and it starts to hold and tested multiple times. And I think that is going to be a really clear. Now, where does that happen? Does that happen to 3,800, 3,400, 3,600, 3,675? I don't know, right?
Well, that's why we have these conversations, Chucky, so that we know we're resting on our technical ability right now. And technically, you're in a bearish downtrend with a very similar momentum scale to the previous waves down. This support level, this double wick, is only being put in from an intraday perspective, and you got a lot of heat coming into it. The most likely scenario is this support level eventually breaks, but support is support until it does. And so, but the reason I love these types of conversations, Chucky, is the market's doing a lot of puking up today, but the market always thinks about the future, thinks about the future.
It does. And
we have to as well. And the only way we can prepare ourselves for that future so that we are ready to buy when there is true blood in the streets, like Warren Buffett preaches, well, we got to have these types of conversations all the time, Chucky. Now, obviously, support's got to hold here, but again, let me just finish my thought technically very quickly. We are in a no man's land of support, and a double wick bottom is just that. It is a double wick put in by algorithms, and we have not seen any substantial increase in volume to justify that double bottom yet. And so what we need to see here from a technical perspective, if you really want to see a little bit of a bottom coming into the market, you got to build off this double bottom wick. You got to build. And what I'm really interested in the next few days, because again, we could be talking later on today about the market violating that support.
Absolutely,
and seeing
100%.
more movements to the downside. Absolutely. That's in the cards. But the reality is we're talking about what we need to see as that buyer's side, because right now every rally is suspect. Every rally is seen as an opportunity to reduce bullish exposure out there. And so what you need to see is on these upward movements in price, as support is building, you got to see increasing volume here too. You got to see a participation rate that is starting to increase as we start to punch up. Like I said the other day, Mark, when you asked me if this was a bearish retracement, I said, yeah, it's got all the hallmarks of a bearish retracement, including the lowering of volume. The lowering of volume shows you that this is just short covering. And that, I remember saying that on the halftime report. You start look at the expansion of volume to the downside. Look at the contraction of volume to the upside. That's not a positive thing for the market. And so you need to see this support level build. Certainly you can build it off a double wick. You also need to start to see, as the market works up, you need to start to see volume start to increase versus the previous downward movements in price. Bears still have control. They have control of the mindset. They have control of the price action. We're waiting for support.
They have control of the narrative. They have control of the narrative right now. Now, I think that changes in 2022. No, I'm more encouraged, not because I think this support level will break. I don't think this will be a 2015. 2015, you had a come down to support and bounce double wick style. I don't think the narrative is just too strong.
You also had massive Chinese capitulation from a regulatory perspective.
Now, if you had a catalyst, like for example, Russia, Ukraine stopped tomorrow.
Oh, that changes a lot.
Then I'm buying a lot of stock tomorrow.
That changes a lot.
But absent the narrative changing, I think
Okay,
what you're
so
going to
what's those two narratives that could change? Because
Jay,
it's got to be
it's the double
geopolitical or the
P's.
inflation.
It's double P's. It's Putin and Powell.
Putin and Powell.
It's the double
That's right.
P's.
You heard it here first. We're putting Putin and Powell into the same sentence together.
It's the double P's. One
The
of them's
double
got to
Ps.
change. One of them's got to change. Until that happens,
You know,
I think you're going to
I
see
thought you were going to go price or policy. I didn't think you were going to go Putin or Powell, but I'm with it. The double P's. Okay. It's either Putin or Powell. I'm with you.
Let's throw in a triple P. It is the triple P. It is Powell, it is Putin, or it is price. Because if I'm right on my de-risking, which I think I am, and I totally stole it from Mohammed El-Reen, the smartest guy on Wall Street. So it's
what about PB and J? Powell.
What's the B?
Okay. Biden.
What's Biden even doing these days?
I was trying to work a PB and J. I was like, but then in my head, I'm like,
Biden is the first president in my lifetime I can insult, and everybody agrees with me. So
I don't know if that's true. I think that might just be true in your circles.
My neighbors agree with it.
Listen, I read a poll just yesterday that 85% of Americans are upset about something. And it's very rare you see that number, but that's inflation for you.
Listen, I read a poll the other day that said 60% disapprove of Biden, 20% are indifferent, and 20% are complaining. Come on, Joe, do something, right? Do something, right?
Well,
all right.
There is an argument out there that says we might not want our presidents to do much.
Well, listen. Inflation.
It's a pretty big historical argument too.
As James Carville said, it's the economy, stupid. When the economy's bad, when something, everybody gets riled up. Okay, let me talk my 3P. So obviously policy Putin's. The third is price though. If I'm right on my de-risking thesis, eventually, if funds are de-risking and all of that, eventually they stop. Eventually, this is what really true classic priced in will look like, is that, all right, we've de-risked enough, we've taken into account the risk, and at that point you will see a support level form. You'll see it tested multiple times. Could happen here, right? There's been a lot of de-risking in the last 5 weeks. Could happen at 30. I mean, it will occur at some point. It happened in 2008, and then things got even worse, right? And then people, things just spun out of control. But you saw, all right, 2008 took a couple months off, right? And, I think that is what is going to occur here. There's going to be de-risking. All right, there's things that could go bad, but it's not end of the world yet, right? And so then you'll find that natural equilibrium.
Well, all I can do is tell you what I would like to see to increase confidence in the marketplace. If this market rip roars V-shape, I will not build confidence in the marketplace.
Nope, me either. I will reduce exposure.
I will reduce. I do not trust any V-shape here.
Nope.
Any V-shape is algo based, and I think you need institutions, hedge funds, and individual investors to come into the marketplace. And so it's not just, let's see a rip roar market here.
You mentioned this yesterday, Matt, the volume on the up days. The volume on the up days was lower than the volume on,
it goes to the mindset and the participation out there in the marketplace. When you have downward movements in price, remember, volume's always equal. And so volume is simply a measurement of participation. And so when the market's going down, and you have additional participation, that's fear grappling the market. Everybody's running out to sell and dump their shares, versus when you see in a bear downtrend and you see markets going back up, you want to try to get an understanding, is that people coming in at the low price, or is that just short covering here? Well, typically speaking, when you have a reduction in volume versus the downward movement in price, in that upward movement in price, that's a lot of times short covering, because I want you to think about the participants out there that actively trade the marketplace, because Mon Par America in a 401k, they have nothing to do with the intraday price action, legitimately nothing. They have zero to do with why the markets move intraday up or intraday down. From the cash open to the cash close, they have nothing to do with anything. They don't buy things, they don't sell things, they passively invest. That gets put into the money, into the market through mutual funds in overnight. They have nothing to do with any of the price action from an intraday perspective. This is all traders. And so when you're looking at traders short, traders buy. And so when the market's going down, 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 yeah, the overnight selling has something to do with it, Mark, but that's a cash open sell. 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 That's traders. And so when you're looking at volume and the level of participation out there, the traders who are shorting, well, to close those transactions, they have to buy that back. Through the buying process, that drives the market back up. So if you see a reduction in volume as the markets are going up, I can promise you it's not just me that's going to be looking at that as simply a short covering, which basically traders, when that nails resistance, the trader's going to repeat the process until that process changes. The only thing that will stop that process is a support build. That's it. That is it. And so that's why we spend so much time in these bearish conditions in the halftime report analyzing support, because that's the only thing that's going to stop this freight train of a market coming down. And once again, we're in the process of support build, not a support catalyst. That's a difference. If there was a support catalyst here, I'd have a lot more confidence in the market's ability to be able to find that stabilization. But because of the vacuum here without a support, we just got to wait out that volatility.
And that's the thing. And that's the thing that is keeping me extra cautious, aside from the duel, because I buy Marco Kolonovic's bullish argument more than I buy Michael Wilson's bearish argument at this point. But I'm a permeable.
I'm more on the, I think a lot of the damage is priced into the marketplace. I do think
especially
that.
Certain areas of the market. I'm sorry if like individuals be like, oh, I'm not going to, when Kramer gets up there.
Look at ARC this week. Just look, you don't have to go far. Look at ARC this week. Nasty market conditions. Everybody's running for the hills, and ARC stabilizes.
Like when Kramer out there, like, listen, you can't have those unprofitable. Like, bro, listen, when are you going to buy them? When they're up 50% from here? There's some really great deals out there.
And that's when Kramer will suggest buying them.
And that's when he'll tell you to buy them when
Kramer talks to Mom Power America, who are watching the markets at 8 o'clock at night.
Yeah, Kramer's a fool. All right. That technical support break is the thing, because that can create a technical event, right? You break support, there's no support underneath, things can spin out of control. That's the thing that has me the most cautious, and that's the thing that is why we pay attention to that support level. Well, we had a good old wax philosophical there for a half hour.
Well, listen, it's a Thursday where we got a doji, Chucky. We don't.
Let's go hurt. Let's go over into commodities real quick. Let's start with gold here. Like we always start with crude oil, but listen, gold deserves to get the first get go. And listen, on the podcast that we have this week, go check it out. Matt and Pete's had some amazing calls, and give the people a little brief analysis of what Pete said about gold, and then listen to the Trading Desk podcast. It is literally, if you do anything with commodities, it is a must listen to. TradingJustice.com.
I certainly agree with that, and tried something new, and I posted a video in Discord earlier today, Chucky. So for the podcast this week, obviously we recorded the podcast. You can download it on any one of your apps. You can check it out there at the Trading Justice website as well. But I also did a screen share this time because this is kind of the first time I've had Pete on for the last few months, and there's been some significant price movements in the commodity market. And so I wanted to give a visual based on our conversation. So I also did a screen share. I posted the video in Discord. I believe it's on the Tackle YouTube as well, but I don't know where I put it. So if you want to get the video for the podcast to kind of follow the conversation from a technical perspective, definitely check that out in Discord. And I believe it's in the general chat discussion in the Discord channel, so definitely check out that video. But for the conversation, we talked a lot about the opportunity, I want to say, at support, and whether or not, because I've been making the base case, Mark, and I've been making the base case on gold for a very long time, especially as GDX works into that $29 to $30 range. And so far so good yet again, V-shaped recoveries. We're going to see some test here, but you got to like the fact, well, not like, but you got to appreciate the fact that once again, 30 holds here in the face of extreme volatility. There's no debate now. 30 has held. You got 4 or 5 bar movement back up. That's a support build. So you could see some additional volatility, but again, proves out yet again, 30 holds. We'll see that retest and see if it can retest against another test. That's a lot of price movement coming in. You're overextended coming into that break. So a little bit of a retest would start building even more confidence there in the gold markets. But, my question to Pete was basically twofold. Number one, Pete, why in this environment, and again, we did the recording about a week ago, but why in this environment is gold not catching a bid, right? Because you're talking about an inflationary environment. You're talking about a market that is completely volatile, and you're talking about a market that has a lot of uncertainty in it. When you see uncertainty and fear build in the market, gold typically does catch a bid. Pete did confirm what I was thinking, that there was some covering here, meaning reducing some bullish exposure in the gold markets to pay down some, negative margin requirements in other more aggressive areas of the market. He did have that same type of thought process,
which would go along with
I,
the general de-risking that has been occurring,
yes,
right?
Yes, it would. It would absolutely fit the theme of reduced bullish exposure as the market on any pullback in the marketplace. There's no doubt about that. Talked to him, and so he did confirm those thoughts as well. And then the second thing I asked him was, do you see this as a buying opportunity as gold and some of the other metals start working into their low prices? And those low prices, you got that 1800 build right here. You got 1750 to 1760 underneath there. And anywhere in this zone historically, you are looking at a pretty decent support level. It's not exactly clean like it's clean on GDX. And I do think that's why one of the reasons I do prefer GDX is the cleanliness of the chart. Plus, you can, if you know covered calls, you can get a lot more premium in GDX than you can say GLD, which is the gold ETF. We're analyzing the futures in gold right here, but GLD is going to give you the exact same picture here. GLD is the ETF, but once again, just to kind of give you an example of what I'm talking about, why I prefer GDX, you can come down to the 40 Delta contract and you can get yourself $2.50. You can get $250 on a covered call here for every 100 shares of ownership, which, $250 against 17th. All right, I'm just doing some quick math here, Chucky. So 250.
What is that, about 13%?
Think about 1.5%.
Okay.
On the cover call.
13% annually. Yeah. I did that math pretty good, man.
Yeah, about 1.5% on a monthly basis. Well, with GDX here, cheaper stock, and we do prefer cheaper stocks for covered calls specifically, but you come down to that same 40 Delta contract and you can get $1.08, right? Well, you get less cash flow, but obviously the cost of the instrument is cheaper as well. Let's just say the cost of the instrument is $32. Well, you get $1.08.
You're looking over 30% annualized there.
3.3% on a monthly basis.
Over
I mean, honestly, compounded, you're looking at 40% there.
Yeah, no,
and so it's not even close. Like it's not even a debate. If you like covered calls and cash flow, naked puts, boomerangs, cash flow, credit spreads, GLD is just, it never has the volatility because GDX has more of the gold in it, right? GDX has that very aggressive silver and some other metals and mining spaces as well. And so I do prefer GDX for those reasons. But when you're looking at gold, and GDX also has much cleaner support level to build off of. But here, gold, a little bit of an outperformer against GDX, kind of holding that 1800 zone. Is it a buying opportunity? Silver coming into that 20 zone, trying to work back up above a very key level of resistance at 22. You come out here on a daily chart, you'll see that punch up against that 22 handle, old support acting as new resistance, downward moving average here. So I certainly think we have work to do from a directional trader's perspective in the commodity market, but you are working into some fairly decent support levels in the precious metals area of the market, including platinum, still hugging that 900 zone. And so you're looking at low prices here. I think they got to be looked at from an investor or a cash flow perspective.
Yeah, no,
And I never want to put words in Pete's mouth, but I do think Pete's looking at it very similar.
Like, I really am. I spent way too much time last night thinking about this de-risking thing. It makes sense to me though, and it makes sense to me if it's true here. I think tech still can go down, but it overperforms the S&P. I think the Q's overperform slightly.
Yeah.
Slightly, just because they've been beat up the most, right? And if we're going to de-risk over some of those other areas, come down a little bit, I think precious metals overperform by a significant amount.
In a world of craziness, I think you can do far worse than owning gold and silver right now.
I think they overperform by a significant amount,
especially gold, gold,
and so especially gold. Especially gold.
Silver's right? An industrial metal that will have economic sensitivity to it, but
yeah. All right, let's go over to crude oil.
For me, and again, this doesn't change a lot for me, but for me, it's whenever I'm looking directional in precious metals, it's typically silver. Whenever you're looking cash flow or investment, it's typically gold.
Yeah, let's go bounce over to crude oil real quick. Down yesterday on the general risk, off today, bouncing today, stuck in its pattern. Not a lot to see here, right? And I mean, the competing factors of, hey, we're going to have a recession, and the fact that supply is so freaking tight. I saw a thing out of JP Morgan yesterday that don't be surprised if you see $6 gas this summer on a national average.
It's punching high fours now. 4.6, 4.7. I don't think, honestly, if we have seen peak inflation, the consumer inflation will still go up, even if peak inflation is set in, because again, PPI report bleeding into CPI report. Summer months, strong demand for energy products in general and oil specifically as people travel more. I know that the analysis out there is going to be people are going to be traveling a lot more because of COVID restrictions are reduced and whatnot. I don't know if I'm there yet, Chucky. I think people are going to be weighing the cost. I think people will be weighing the cost of vacations this year.
Gasoline is such a political issue. In the 2008 presidential election, John McCain, and this is before gas prices were high. Gas prices were high. This is like,
it's the one thing people see, Mark. They see it every day. They see that tick go up, and they're like, "Ooh, I don't know who's to blame, but I'm blaming somebody."
Because Americans like change, right? They like to vote the old party out after a few years. That's pretty common in American politics. And Bush had been in there for 8 years, and gas prices were high. McCain was like every day, like gas prices. I mean, that was like the big thing. I'm going to get gas prices down, and then Bear Stearns, and then we had the whole financial crisis, and it was like, well,
that took care of gas prices. That took care of gas prices.
So,
John McCain lost his argument coming into that election.
If you have high summer prices, I mean, I don't know how much the Democrats can do to fight that. But you get high prices, and the closer you get to those November elections, man, it is not going to be due to a lack of trying. It is not going to be due to a lack of trying, because I mean, it is just such a massive political issue.
What are they going to do?
Well, I don't.
What are they going to do? Tell me what John McCain did other than just talking about his desire for lower gas prices. Yeah, they're going to talk about the desire for lower gas prices. We live in a free market, and no, talk all you want.
Well, the one thing Biden the other day, was basically trying to reduce the sanctions on the Venezuela strongman to try to do something, right? I mean, we'll see what happens. I think you might see more action. But the plain simple fact is Russia, as long as Russia, Ukraine, oil ain't dropping to 70 anytime soon, right?
No, I mean, as long as you have geopolitical strife in Eastern Europe, it's tough to see, even in a recession, which, if we go through a recession, oil typically takes it on the chin pretty healthy, right? Got smoked in 08, especially in the later half of 08. And yeah, that the market kind of fixed John McCain's problem for him. I do remember
Jay Powell's going to try to fix
that
everything.
debate, but
let's create That's how you fix inflation. There,
but
you just blow up the entire
reality,
financial
Chucky,
system.
Well, how do you fix national debt that's run out of control?
Yeah.
And I want you to think about this. If we're going to put on that little tinfoil hat for a second, what is one of the ways you fix runaway inflation?
On the national
excuse me. What is one of the ways you fix debt?
Well,
if you have a debt problem in your country,
you have to have high inflation.
You build inflation on purpose to create a higher currency to pay down the previous debt burden. That's how you do it.
It's the only way you do it.
And you can only go to about 100 different examples in history in the last 100 years of pointing to countries that do just that. Look at Brazil in the late 80s and 1990s. They did it multiple times.
It's the only way the reckless spending the governments do over the last 20 years is the only way you can sustain the debt is to have a level of inflation.
So there's a reason I could care less what any politician says, because they have very little to do with anything. They're part of the problem, not part of the solution. And so when you're looking at oil, though, Chucky, even in a recession, it's tough to see, even with the reduction in demand, as long as that Eastern European situation is going on with the war in Ukraine, it's tough to see too low of prices here in the oil market. And it's not just the ongoing crisis. It's the fact that you're now starting to see even more sanctions. And you're now starting to see corporations do even more things. McDonald's, literally, legitimately today, McDonald's just sold all their business of Russia,
all their businesses,
to somebody else. Like this is
McRib,
not a short thing.
Listen, it's the first.
We're sorry, people in Moscow, you're not getting a McRib.
I really seriously, people in Russia, because there's a lot, it's a whole thing, but I do feel bad for any human being who cannot get a McRib.
I feel bad for any human being that has to eat a McRib.
Listen, it is that. No, I mean, we could talk about crude oil. Let's talk about Bitcoin for a second. Trying to bounce. Listen, if the whole whatever
got an arc feel to it, doesn't it?
I was just gonna say the same thing, right? Just gonna say the same thing.
Little tight consolidation, K trade scenario. I don't have a read here though, Chuck.
No. It's early to call, but I do believe. I mean, Tim is the true gospel believer in Bitcoin. I genuinely believe Bitcoin is at 150,000 in the next 10 years.
And I believe I will make money on that
Matt
next support build.
Doesn't care. He's like, give me a technical pattern.
That's all I care about.
Beat up all year, scary moment, like the fear of that subsiding. It's going to be really interesting because there's nothing to see here today. It's going to be interesting to see if it, and this is what I'm really looking for on the whole de-risking. Does it continue to trade with risk assets, or does it just go back to the rut? I'm going to do nothing here. We're going to find that answer, especially on a support break of the S&P. If that occurs, you're going to find that answer out really quick.
I think,
right?
If you see a continuation of the downward movement in price we've seen in the S&P and a continuation of the current trend, which would be a violation of support, that's why the probability is still to the downside here. Because again, there's nothing really changed technically to change that perspective. You've had the exact same volatility up and down. You've had the expansion of price movement to the downside. Technically, it's actually been very consistent. And so to me, if you see a violation of support here, it's really hard not to see Bitcoin continuing to move down.
It is. I mean, we're going to see, does it relatively just glide, or that, I'm really curious.
Give me a number. Give me your number, Chucky. You know how we all have numbers, right? And whenever you talk to a trader and you say, give me your number, you know exactly what it means. Where's that number on the chart where you're like,
I have a tranche plan. It starts at 22,000.
200-day moving average on the weekly.
Yeah, I'm buying my first tranche there. Now I might get a pattern earlier at a higher level, and
I ask him your number.
But as far as blind bets, I'm buying a tranche at 22,000. I'm buying a tranche at 18,000, and then I'm going to be patient on the next, and then I'm double tranching it in the 12, 13.
In the 12, the previous right there.
Yeah.
I certainly see your analysis here in that 22 to
I'm going to
18
tickle it. Like
range.
my first tranche is usually
No,
pretty conservative. I'm going to tickle it.
You're scaling in, right? You're scaling in,
Like
little
give myself, if it
conservative
goes
scaling in.
down.
I'll tell you, you work into that 10 range. You work into that range here. That's a foundational support level. Foundational support level. So, man, I think that would be my number 12.
So
but again, I don't have that belief that you have to a certain degree, and Tim has to a large extent. So to me, it's got to be a massive value, and it also it's got to be supportive.
And that's why I tickle it a little higher,
tickle
it a little higher, tickle it a little bit down. I mean, that's just how I approach these things. Listen, I'm gonna get paid, or I'm gonna get paid. I now, of course, we'll form support and go up and on it. And I'll
listen. Hey, listen, I don't care about that. Like, if you form support at 30K and you give us a good edge, fantastic. We'll be here. We'll break it down. If you give us that edge at 10, fantastic.
I am prepared.
You got to give us the edge.
Yeah, and that's really what it comes down to. And this is a phrase I've used a couple times in the last week in my cash flow and Vikings training lab. I want to put my money to work when I feel I have a significant edge. Now, in normal conditions, I'll do little slight edges all the time, right? I'll hey, I think I got an edge. I'm willing to put money to work. I want to feel the significant edges. And I think there's a lot of people like me. That's why those support levels, those patterns, those price levels, whatever they are, people are going to put money to work. They're not de-risking today to sit in cash forever.
The cash on the sidelines argument is only made to people with zero knowledge in the market.
So
cash moves in, cash moves out. Cash moves in, cash moves out.
All right, let's get over to stock talk. I mean, listen, it's all about, I'm sure you'll mention Cisco here in a second, but we got to talk about retail earnings, right? That's the story of the market the last 24 hours.
Well, it's the story of the market with Walmart and Target, obviously, this week, and Walmart
and the bleed over effect to Costco. And I mean, it just,
retail in general, right? I mean, retail in general, when the leaders of this space, Walmart and Target, when they hit the numbers they did this week, and they had the lowering of guidance, and they had the concern.
This feels like Verizon's chart to me.
Those increasing costs, the margin that is expanding, and Target's additional $1 billion in costs associated just a higher cost of running their business. That spooked a lot of investors in the retail space, because if the big dogs like Walmart are not being able to handle some of this additional cost measures, what about some of those smaller companies like BJ Wholesales, right? And so, yeah, you certainly did have that spark some, and this will happen. Things that did hold up in the initial stages of volatility, if those levers break in the market, and that dam breaks in the market, they catch up to the volatility skew of the rest of the market really, really, really fast. And that's what's happening this week, is that the retail space and specifically consumer staples, but retail in general, because you both have consumer discretionary and you have consumer staples, one defensive, one aggressive, but they are both retail. And so when you had that occur on Walmart and Target earlier this week, it just sparked that volatility to catch up with the rest of the marketplace. And so definitely concerning here in the retail space, but they are dealing with some significant price increases from a margin perspective, from a wage perspective. And again, whether or not we've seen peak inflation, you never know in the moment. But even if peak inflation has set in from the producer's perspective, we're not going to start seeing it for the next few months. And so
listen, I've seen this, and as one of the listen, a couple comments here. I've seen the algorithmic. I saw this. When was it? 2018, 2016. I can't remember exactly when it was, but it was there was oh, producer cost is going to. Staples got hammered in that, and that was a normally calm market.
Yeah.
In this where the market's unhinged. It is. I love Walmart, and I will buy Walmart at some point. I gotta see a pattern, and I gotta see.
It's a falling knife here, Jackie.
You are likely months away from the type of pattern that
minimum weeks,
but more probably months, right? And you're seeing it's not. I mean, what the heck? Like, that candle.
It's the bloodbath is real. There's no doubt about that.
And this is my general point, because there's been a mentality, when markets get tough, people go to areas where they feel safe, right? Like, where, like, oh, well, I don't have this underbelly stock, I'm going to go to Campbell Soup because Campbell Soup is safe. If we're going through a de-risking phase right now, and that mentality treats you really well, right? That mentality treats you really well, but everything's unhinged right now, and I don't know where these stocks, once you start these events.
Well, I'm not sure traditional sector rotation models are going to work in this environment.
Not right now.
And what I mean by that is traditional rotation models typically don't project the inflationary scales we're dealing with right now. And so specifically the retail side of the equation, for me, it just sparked a lot of fear. I think we need to see this stabilize, but I don't feel like Staples itself is just gone. And
Staples is will you pull up the Verizon chart?
I do think Staples will reemerge as the safety area of the marketplace.
No.
I think
as soon as I get a pattern, I'm adding Staples. But the thing about the Verizon, boring company, right? Good company, right? Steady company. That 6-day sell-off was pretty dramatic, right? It was like down. Like, you don't know where it settles. Then you get that little hammer candle, get some upward movement, and
well, this is a good example of what you want to see in Walmart. This is a good example of what you want to see in Target. You want to see a little bit of upward drift. You want to see some stabilization, and you want to start working into reversal analysis.
Yep.
I think we do. I think we are seeing an overreaction to price.
It's total. It's a technical event.
Well, that, and this is the week you do not want to report earnings in, like, at all, like legitimately at all. Walmart cashed in $141 billion this quarter. Target exceeded the expectation on revenue. The market mentality is in no mood to deal with anything right now.
Anything at all.
Like, legitimately. And so when you report on a week like this, you are going to see an exasperated price action. So I do think we're overshooting to the downside here, a little bit in Walmart, a little bit in Target. And when you look at some of the other retail stores that are reporting here this week, you're going to see a very similar picture here, Chucky, because they're all responding to what Walmart did. They're all doing the exact same thing. You had Bath and Body Works here report today. They actually beat on EPS numbers and came in line on revenue, Mark. They came in at 64 cents versus 51 cents on the EPS projection. They came in at 1.4 billion versus the 1.4 billion on revenue. That's a beat in line. What did they do? Where's the volatility? Why are we down 7%? Well, they lowered their guidance and they cited the exact same things that Walmart cited. They cited the exact same things that Target cited from the previous day.
What's funny, you bring up that stock. I didn't know you were.
Well, what happens really quickly, Chucky, is when the generals of a space, and Walmart is the general of this space, when they come out and say, we're dealing with X, Y, and Z, that gives the authorization to every other CEO in this space to say, hey, listen, we're dealing with some significant pain out there as well. And if Walmart's going through it, well, we're going through it as well. You're seeing that bleed into the rest of the areas of the market. Bed Bath & Beyond here comes out, says the exact same things. They talk about margin tightness, increasing wages, talked about the exact same things that Walmart and Target did. And when you look at BJ,
and I want go back to BBWY real quick. Yeah. I just, you know how I love to read message boards. For the first time ever, I read a BBWI message board last night. Mm-hmm. Like, not a stock I follow, not a stock, and a person laid out this like amazing bullish argument on why to buy. It was just like, I'm buying, right now because of this and that. And I'm like, slow your roll, bro. You made one of the best cases I've ever heard for it. It was just brilliant. I thought it was great. I'm like, but this thing can spin out of control from a technical perspective.
That's because
right?
they make the base case, Chucky, and then they trade based on their base case. What they need to do is make their base case and have that as the case for them to prepare to take action based on technical
and that
analysis.
is how you do it.
Because one of the best economists of all time, one of the best, most accurate economist of all time was a guy by the name of John Maynard Keynes. And John Maynard Keynes, famous for Keynesian economic policies of the 1930s, which has dominated the economic landscape for most G20 countries for the last 80, 90 years. What John Maynard Keynes basically predicted, Chucky, he predicted the 1929 crisis. He predicted it. He laid out his entire argument. He predicted it. But guess what? He traded based on his predictions and not based on the price action. He was too early. And then he predicted
those puts bleed, Keynes. Those puts bleed.
He predicted the bottom. But you know what? He tried to buy too soon. The bottom didn't come
those
in for
calls
2 years
bleed.
later. Listen, it's you build your base case that prepares you to take action, but you cannot trade based on your belief system because the market is far more nuanced and far more intelligent than just I am. I got to wait for the collective market to give me that signal. And
Matt Justice just said right there in the last 60 seconds, you need to rewatch again. That is the key to you reaching your financial objectives. Like, I love XYZ company. That's great. Put the technicals. Don't try to be greedy. Wait for other people, the signals. I mean, that really is the key. Using technical analysis to back up and help you determine the timing of your fundamental analysis. That 1-2 punch will make you a lot of money in the next 20 years.
My base case in ARC related instruments, Mark, is they're in a buy zone.
Huge. I think it's a massive buy zone.
But you cannot touch them until you have an edge.
Yep.
And that is technically. And the same thing is going to be said about Walmart here.
Because I'm not interested, Matt. I'm not interested in playing a 4-day rally on ARC.
No.
I'm
interested in trading it.
Yeah, sure, right. If I can make a few bucks. What I'm really interested in 2022 is adding things at ridiculously prices that I can make some serious. I won't be selling 0.4 delta calls on the stuff.
See, I might be selling. My question, Mark, I just don't know if we're going to get a better deal.
I think just like the peak of 2021, you will never see the high prices on some stocks again at those levels because it was insane.
There are numerous stocks that peaked in pandemic that you'll never touch again.
You just won't ever hit those prices again.
Yep, I agree.
It just never will happen.
And quite a bit.
And a lot of them. Yeah. And even great companies like PayPal, you might not see that price again for 20 years.
Take Zoom, for example.
Yeah, Zoom.
Like Zoom is a wonderful company. I think Zoom's going to be around for a long time. I'm not sure you're ever going to see the combination of events again that would have this little company do this now that other bigger companies are now starting to say, "Ooh, we want to take some."
Zoom's never hit 600 again.
Like whether it does or not, I don't think you're ever going to see the combination of events again that would ever create that type of volatility. And so, yeah, Chucky,
I think 2022 will also hit for some stocks the lowest.
You'll never see the low price again
that you see in a long time. And I'm not interested because I love cash flow in normal times. This isn't normal times. I'm not interested in selling calls, on the things, maybe 0.1 delta calls that I roll. I'm interested in adding some crap, like long term. And it's just, and I'm patiently waiting for technicals to give me the signal, not to make a 4-day trade, to make a 4-year or longer investment. So.
Yeah, I think that's my mentality as well, Chucky. And when you're looking at the retail space here, same type of conversation, falling knife here. You got to let it settle down. You don't know where the bottom is because it's violated so many other support levels. You've really got to let it settle down. Now, I will say, if you're looking foundational here at foundational support levels, that is, you start working into the 105 range on Walmart. You got to start paying attention. There's no doubt in my mind. That's low price, a pandemic. Think about that. For a second. That's the low price of the pandemic in Walmart. They just cashed $141 billion, guys.
There's a few blue chip companies I'm really, really interested in. I mean, I got all kinds of, I got more underbelly stocks
There's more
than
honestly,
I know what to do with.
Honestly, Chucky, I do feel like maybe not today, because today's a lot about patience, but there's many scenarios in the near future where there's more opportunity than you have capital.
Yeah, and
because you don't need 100 trades and you don't need 50 investments.
No, and which is also why you have the time to be patient, right? Like, yes. Put it, but like Walmart, Disney, Apple, Google, like some of the blue chips, when we get those bottoming patterns, I'm honestly, those, there's some stuff that I'm going to be very interested in.
Well, absolutely. And I think for most investors and traders, they have the same mindset. But again, patience is a virtue that is extremely difficult right now in these times. But you just especially on a Walmart, because nobody's going to be looking to short Walmart, like legitimately nobody. It's a matter of being patient, letting this initial surge in volatility to the downside settle down. And it's a very similar read, because again, what I feel is happening here, because I've seen it in sector rotation this year, when a sector holds up and then that dam breaks, it catches up to the rest of the market and then it stabilizes. I expect consumer staples to stabilize here. I do think we're seeing an initial surge in volatility to the downside, but I do expect staples to consolidate. I don't think you're seeing the spark of something greater.
I don't either. I think this is a Verizon
you're seeing something
type
catching up.
Yeah.
And it's going to settle down.
Yeah, I think that's a pretty. I think that's a pretty safe call on the table. What else you got for us in stock up?
I got one other here, Cisco System, CSCO here, Chucky. Let me get the symbol right. Then you can send us out here. Cisco, just another gap down, sell down on a report where they lower EPS and revenue guidance here. Cisco 87 cents versus 86, so right in line on EPS. Revenue actually did not exceed the expectation. That was 13.3 billion. They actually came in at about 12.8, and so they actually start off on just the raw numbers were bad. Just the raw numbers, based on their raw numbers alone in this earnings season, not this week, but in this earnings season, their raw numbers would have been a gap down and sell down. Yet on top of that, lowering of both EPS and revenue guidance throughout 2022, the combination of that was just too much. Gap down, sell down. And again, wrong day to report earnings, wrong week to report earnings. But this would have happened on Cisco, in my opinion, at any point during this earnings season. You lower guidance like this and you miss revenue. Remember, even in a very difficult time for the marketplace, you still had 79% of companies beat EPS numbers. You still had 74% of companies exceed revenue, and you still had a blended growth rate that went from 4% to 9% throughout the earnings season, Chucky. All of those were positive metrics. Cisco lowers guidance. That's against what the market's doing in general, in terms of, we've had a lot of lowering of guidance this week, but it was this was a gap down, sell down against any earnings this quarter. So tough day, tough week, but just tough report coming out of Cisco. I understand the gap down and sell down. When you're looking at the type of price movement to the downside, is there any support level you can hang your hat on? Yeah.
Pandemic lows.
Yeah. One a little bit lower than this. You can expect to see a little bit more selling here in Cisco.
Yeah, no, you're probably, listen, once again, there are so many stocks at some point in 2022 that pick up. It really is creating a watch list, because you're not going to have money to buy them all, right? Pick your favorites, create watch list, be patiently wait for the pattern. That's my final thoughts. The stuff that we've been reiterating for a while now. I don't know if the support level will hold here. There seems to be a lot of steam,
my final
but eventually one will.
Well, I know, and yeah, we all know that. But again, it's sometimes, especially for new traders that haven't seen this type of market mentality before, it can be tough mentally. There's no doubt it. But my final thoughts are really simple. Do not judge the market based on your own personal perspective of the economy. That's not how it works. I promise you the market will bottom before the economy does. The market prices things in. The market is forward thinking. And by the time it actually hits the actual mainstream news wires, the recession will be here economically if we do go through one. But you could absolutely see a scenario where you see a double bottom in the market at that point as well.
And that's the thing, is the market will front run once
It
the
always
data starts.
does.
It
Well, think about it right
does.
now. 20% downward movement of price so far this year, marking the GDP of America is going up. It's because of the concern about the future. As we solve the concerns of the future, we reverse in the marketplace.
And if you're the type that says, I'm going to put my money to work when inflation gets down to 3%, market's going to be at all-time highs.
We will be back in. We'll be talking about the next recession, guys. I'm not kidding. If you're waiting for inflation to get back down, we will be talking about the third recession from this recession here. That is so far down the road. Markets forward thinking.
No, and so it is why technical analysis is king, queen, and country in the coming months. And those broad market charts, those bottoming patterns, this thing is not going to, without Putin, Powell, Powell's not doing it. Like Powell's not, but at some point a bottoming pattern will form, and it's not going to be when inflation's at 3%. It's not, it's going to, and when it forms and the de-risking is over, you're going to want to put money to work. I mean, you're going to want to put money to work, or else you're not going to want to chase it 20% higher, 40% higher on certain stocks. You'll trade it, right? You'll trade anything on any pattern, but we're talking your long-term investments, and we'll do our best to help identify that bottoming pattern, whether it happens in June, July, August.
I do it every reversal. I track every reversal for our community in the halftime report. And as we're going through any reversal, both up and down, I go through the process of the art of the reversal, and I do it live in the halftime report all the time.
And I'm prone to hyperbole. I know that about myself, but that reversal pattern will be the most important reversal pattern for my Roth account in the next 20 years. And maybe not, maybe the next 6 years. It's an important one. It's going to be an important one.
And you know what point one is? Double wick bottom.
But
that's the first data point in about 40,000 data points. So
hey, listen, I'm just going to say one thing. One last thing. Two things. One, Cash Flow Vikings tonight at 7 p.m. Eastern. Cash Flow Club at 8:30.
Coach Greg Holmes doing Cash Flow Club tonight.
So we got Greg tonight. I'm going to be hosting the Cash Flow Vikings Training Lab at 7 p.m. Skull to all members out there. Just to give bulls some optimism, will you give me a historical chart going back 10 years on I need a daily chart, actually.
You want a daily chart?
I need a daily chart. Go back about 10 years. And go back to 2015 at the start of 2016. And I think the market is probably going to break support here. But that's double wick bottom at the end of 2015.
That is a double wick bottom. No, you don't get your last point. You ended on double wick bottom. That is how we are ending this halftime report.
All right. Have a wonderful day, everyone.
We'll see you tomorrow. Next halftime report has Coach Frank and myself and Coach Mark. Frank starts tomorrow, guys. Got the Cash Flow Club tonight. Got Mark's Trading Lab tonight as well. Cash Flow Thursday. Check it out. I did post the Trading Justice podcast, both the actual podcast link as well as the video for the Pete Thomas interview in Discord. Definitely check that out. And if you have any questions for any one of us at Tackle, hit us up in the Tackle Train Discord. Until tomorrow, you guys have a wonderful rest of your day.
Have a good day, everyone.
Double wick bottom. That's funny.
Yeah, no, we don't have the catalyst. I mean, if you just had.
It needs a catalyst. There's